Hi, and welcome to this week's market presentation. Latest news. In the latest news impacting global energy markets, we begin with the situation in the Middle East. Over the past week, the United States and President Trump have continued to escalate tensions with Iran before recently shifting to attempting additional diplomacy and dialogue. The United States has continued to move military assets into the region over the past week, with additional naval assets and particularly air defense systems being brought to the Middle East, which some are speculating to be in anticipation of military action against Iran, and those assets will there be then to defend U.S. military bases and personnel in the region. Nonetheless, there's still reports and statements out of the White House that the U.S. and Iran are seriously discussing negotiations to avoid military confrontation. But nonetheless, markets are very much on edge regarding what will happen in the Middle East. Crude oil prices surged to 6-month highs at the end of last week, pushing up above $71 a barrel on supply disruption fears to Iran's nearly 1.4 million barrels per day of oil exports. Additionally, oil traders are adding a risk premium in case of a potential closure to trade through the Strait of Hormuz, through which 30% of global trade went through in 2023 and 20% of global LNG. Earlier this Monday, markets reversed some of the bullishness that we saw at the end of last week, with Brent crude oil prices down 6% to around $66 a barrel, but nonetheless continuing the upward trend we've seen in crude oil prices. The European Union and India signed a historic trade deal, which will create a 2 billion person free trade zone and covering roughly a quarter of the globe's GDP. India was able to secure 1.6 million tons of duty-free steel quotas, half of their exports to the EU, while very importantly for the European Union, India was not able to receive exemptions to CBAM despite intensing lobbying efforts. Overall, the impact on markets will likely be felt once the new trade deal has been implemented. The steel quota relief has reduced some of the CBAM compliance pressure on Indian exporters, but very importantly, the fact that the European Union did not back down further from additional exceptions to the CBAM is potentially to be set a precedent for negotiations with the United States, which has been demanding exceptions to the CBAM rules. Although we do see a limited direct impact on energy trade and energy markets, this will certainly have significant geopolitical implications for the two economies and for the global economy. Lastly, looking over at the US, President Trump announced his pick to be nominated as the next chairman of the Federal Reserve in Kevin Warsh. Kevin Warsh is an experienced and a former governor at the Federal Reserve, with markets reacting positively to the news, reducing the significant concerns that the next federal chair would become much more politicized and much more compliant to the White House. The resume and experience of Kevin Warsh lending some easing of those concerns. Precious metals decreased after the news, with gold coming down 12% and silver nearly 30%. The US dollar similarly rebounded strongly, with the exchange rate versus the euro now below 1.185. Concerns still linger over the independence of the Federal Reserve, especially given the ongoing legal proceedings against its current chairman, Jerome Powell. Nonetheless, as we gear up to the nominations process for Mr. Warsh, that will shed more light as to what his views are regarding the independence of the Fed and also monetary and fiscal policy for the US, with more news certainly yet to come. Weather. Moving on to weather forecast, temperatures across most of Western Europe in particular are expected to remain slightly above the seasonal average for this time of year. In Northern Europe, we continue to see well below average temperatures persist, particularly in the Nordics. Precipitation is expected to be concentrated particularly in southwestern Europe and along the Mediterranean, with limited precipitation over the Nordics, which is already experiencing multi-year low levels of snow, which in turn is hurting their hydrological balances in the region. Over in terms of average wind speeds, we do see an improved picture, especially at the beginning of this week, which will continue particularly through the end and beginning of the following week. Microeconomics. In the latest microeconomic indicators, we have the manufacturing PMIs for China from the National Bureau of Statistics, which showed a slight decrease in the manufacturing PMI, falling now slightly below the 50-point level. Too soon to tell if this is a sign of a contraction in the sector, but certainly an important indicator to keep an eye out. Crude oil and LPG. Moving towards crude oil markets, as we noted earlier, a noticeable rebound in crude oil prices over the past week on the back of the rising tensions between the US and Iran, particularly as the US has sent out rather maximalist demands towards Iran, including a complete halt to their nuclear program, the handover of all highly enriched uranium by Iran, and very importantly, constraints on the number of ballistic missiles and range of ballistic missiles that Iran is allowed to have. Iran has publicly said it is not willing to negotiate on all of those factors. And at the same time, we do continue to see the US bringing additional military assets in the region. Nonetheless, we did see a slight price correction so far today, with pricing decreasing by almost $5 per barrel for Brent, in what could be a signal of the report of additional dialogue between the two countries, as well as some profit taking given the sharp rise in prices the previous week. Nonetheless, the EIA continues to forecast an oversupplied market, with the first half of the year seeing as much as 4 million barrels per day of extra supply. That is certainly keeping the risk premium from the Middle East contained and continuing to add downward pressure on crude oil prices, particularly for the remainder of 2026. Natural gas. Natural gas prices have now seen a further increase week over week, particularly in the remainder of 2026, with prices up between 5.1% and 6% this year. At the same time, the frontier saw an increase of 4.6% on the week. Further along the curve, we see a more stable price evolution with less bullish sentiment in the market. Storage levels continue to come down over the past week and have been one of the main bullish concerns in the market currently. Storage levels have dipped to 41% as of the end of last week, a full 12.5 percentage points lower than the last year and at a 4-year low. When we look at storage levels across European countries, we see that stocks at key countries such as the Netherlands and Germany are even significantly lower than the European average, raising concerns for the European security of supply moving forward. The risk of a new bout of very low temperatures in the second week of February, adding further concerns and pressure on storage levels and on pricing. Injections and withdrawals over the past week showed withdrawals near the highest levels since at least 2012, and given those colder temperatures forecast for the second week of February, we could be looking at even heftier withdrawals through February than previous years. In terms of total supply and demand, total demand has eased down over the past week given the milder weather compared to previous weeks than we've seen. And the current weather forecast for the next 7 to 10 days should keep total demand from surging again. But nonetheless, we are seeing pretty volatile weather conditions, so important to keep an eye out on those developments. In terms of total supply, we see a relatively stable picture with a slight uptick over the last few days. The uptick in total supply has primarily come from an increase in LNG sendouts and an increase in LNG imports. The increase in LNG imports into Europe has come as the supply disruptions to domestic production in the US due to the severe winter storms through the previous weekend led to a reduction in LNG exports out of the US. Now that those issues are being gradually resolved, we are seeing an uptick in those LNG exports, and for Europe, meaning greater imports there. In terms of global energy export destinations, at the same time as we're seeing greater flows to Europe, we are also seeing an uptick in flows to Asian importers. Although, as we've noted, Asian demand for LNG does remain on the weaker end compared to previous years. Price competition with Asian importers has also been currently in favor of the European side of things, particularly given the increase in the price level we've seen over the past week. In terms of investment fund positions, we've seen that turn towards a net long positions as the bullish sentiment appears to be winning out. Coal. Coal prices over the past week saw a slight uptick there, particularly in Asia, and that has mostly been due to Indonesia's government plans to reduce coal output in 2026 by 24%. And prioritizing domestic consumption over exports. Over in Europe, we see a more neutral price evolution owing to the limited demand for coal across the continent and the still comfortable levels of coal stocks at ARA terminals. EU and UK emission allowances. Carbon allowances saw a price correction downwards over the past week, with prices decreasing 8% on the European market and nearly 9.5% on the UK market. We certainly see some profit taking amongst market participants, leading to the sharp, steep decrease we saw over the past week, as prices have been rising higher and higher towards historical highs. This is the sharpest downward correction since January in 2024, and we do see the technical breakdown below €80 per ton triggering some stop losses as well. In terms of emissions across Europe, those have remained relatively in line with what we've seen over the past 5-year average. Nonetheless, investment fund positions remain near record long positions, although they have come down a bit over the past couple of weeks. But nonetheless, given the expectations of tighter EU ETS balances starting in 2026, we still see bullish sentiment in the market. Electricity. Electricity prices came down over the past week, particularly when we look at the forward curve, with prices for calendar 28 and 2029 coming down around 2.7% each. For the frontier, we saw more limited movement, with prices down 1.6% on the week, and prices for the remainder of 2026 seeing quite limited movement week over week. A similar trend can be seen across European markets and the Nordics. In terms of the supply and demand situation, total demand has remained relatively stable, certainly near the higher end of the range over the past 5 years, in part owed to the ongoing weather conditions. Nuclear power generation across Europe came down over the past week as a couple of French nuclear power generators had to reduce output due to some issues, but they're not expected to be long-lasting, and we could see a rebound in total nuclear output over the coming weeks. Both renewable and fossil power generation saw relatively stable evolutions over the past week, with renewables near the top of the range over the past 5 years, as well as for fossil fuels. In terms of renewables, we've certainly seen hydro reservoir generation at a 5-year high, while very importantly, wind and solar power output have remained closer in line with the past 5-year average, despite the additions in generation capacity. Fossil generation has in turn remained at quite high levels for this time of year in order to make up for the lower renewable output over the last couple of weeks. And lastly, when we look at the price evolution of countries of origin, more limited movement over the past week, a slight decrease in the price level for the 2026 production year, with a slight upside of a few cents when we look at the forward curve, but not much of note over this past week. That covers this market presentation. Thank you for joining.